What if I told you that one harmless little habit, not a luxury car, not a bad mortgage, not some gambling addiction, could quietly cost you almost $300,000 over a working lifetime? Not because coffee is evil, but because every morning, millions of Americans are making the same trade without realizing it. Consumption now instead of ownership later. And that trade is happening in a country where 66% of adults drank coffee yesterday, where specialty coffee is booming, and where the price of food away from home keeps rising faster than a lot of people's incomes. So I ran an experiment. I stopped buying coffee for 1 year and invested the difference. What happened next completely changed the way I think about money. Let's be honest. Nobody feels poor buying coffee. That's the genius of small spending. A $6 coffee doesn't feel like a financial decision. It feels like a reward, a ritual, a tiny little emotional rescue before 9 a.m. You're tired, you're stressed, you've got meetings, bills, emails, traffic, inflation, maybe kids, maybe debt. So you tap your card, hear the little beep, and move on. No pain, no alarm, no moment where your brain says, "Careful, this choice is shaping your future." That's the real problem. The danger is not the coffee itself. The danger is the invisibility of repeated financial behavior. And in the US economy, that invisibility has become expensive. In 2025, overall CPI rose 2.7%, but food away from home rose 4.1%. Even the category including coffee and tea posted an 11.8% increase. In other words, the habit is not just recurring, it's inflating. Now add the bigger backdrop. The US personal saving rate was only around 4.0% in late 2025, according to federal data. That means a huge number of households are operating with very little margin between income and lifestyle. So when people say, "It's just coffee," I understand the logic. But economically, just coffee is often shorthand for something much bigger. A system where income comes in, spending goes out, and almost nothing gets converted into assets. And if that continues for 10, 20, 30 years, the cost is not caffeine. The cost is forfeited compounding. So here's what I did. For 1 year, I stopped buying coffee outside the house, not because I wanted to become miserable, not because I think deprivation is a personality trait, and definitely not because I believe coffee is the reason people struggle financially. I did it because I wanted to test a much bigger question. What happens when a daily convenience gets converted into a long-term asset? Let's use a realistic American example. Say your weekday coffee costs $6. That's $30 a week. Over 52 weeks, that's $1,560 a year. Now here's where things get interesting. If that $1,560 is invested gradually over 1 year and then left alone for 30 years, using a long-term stock market return assumption of about 10%, it grows to roughly $29,000. But if you repeat that same behavior every year for 30 years, now you're looking at roughly $294,000. Same coffee, same person, same income, different direction of cash flow. That's not a budgeting trick. That's capital formation. And that's where the story stops being about coffee and starts being about the difference between being a customer and being an owner. For reference, Fidelity notes the S&P 500 has returned about 10% annually since 1957 and about 10.4% annualized over the last 30 years through December 2025. This idea matters even more in the US because America is built around convenience spending. Drive-through everything, subscription everything, delivery everything, premium everything. And coffee sits right at the center of that culture. The National Coffee Association says 46% of American adults had specialty coffee in the past day, up 84% since 2011, and specialty drinkers are more likely to get that coffee prepared out of home. That's not a judgment, it's just market reality. America sells speed, personalization, and little emotional upgrades, and coffee shops are incredibly good at packaging a feeling: comfort, status, identity, momentum, even self-care. But the market doesn't care what story you tell yourself about the purchase. It only cares where the money goes after you earn it. Does it disappear into a moment, or does it become a claim on future profits? That is the line separating most consumers from most investors. And here's the part people miss. When inflation runs, your habits get repriced faster than your identity does. You still think of yourself as just grabbing coffee, but the economy has quietly upgraded that habit into a bigger and bigger monthly expense. Toast's restaurant data showed the median price of a regular drip coffee in restaurants hit $3.65 in February 2026, up 4.3% year over year, while cold brew reached $5.58. So the habit doesn't stand still. It compounds against you. Now let's zoom out, because this is where the economist in me has to say something important. Saving money is not the same as building wealth. Saving is defensive. Investing is productive. A saver holds dollars. An investor owns businesses, earnings, dividends, innovation, pricing power, and time. That distinction matters in a country where inflation is always nibbling at your cash. If you saved that $1,560 and left it sitting in a checking account earning basically nothing, then even at 2025's 2.7% inflation, its purchasing power would decline. And if the thing you were buying was part of the food away from home category, which rose 4.1%, your coffee money would lose purchasing power even faster relative to the habit you were trying to fund. Now, to be fair, this isn't 2021 anymore. Short-term interest rates did rise dramatically. The effective federal funds rate was around 3.72% in December 2025 and 3.64% in February 2026. So yes, cash finally started earning something again. But here's the catch. Higher cash yields can help you park money. They do not replace long-term ownership. Cash preserves optionality. Equities build upside. That's why the coffee experiment mattered to me. I wasn't trying to become a better coupon clipper. I was trying to become the type of person who routes small surpluses into productive assets. That's a radically different identity. Let me show you what this looks like in real life. Imagine two Americans, David and John. Both are 30 years old, both make the same salary. Both work hard, both feel financially stretched. David buys a $6 weekday coffee. John brews at home and automatically invests the same $30 a week. Now in month 1, the difference is invisible. David feels normal, John feels slightly annoying. David gets convenience, John gets almost nothing emotionally exciting. But fast forward 10 years, if John keeps investing that coffee money and earns around 10% annually, he ends up with roughly $26,600. After 20 years, around $98,700. After 30 years, around $293,900. And here's the wild part. Over those 30 years, John only contributed about $46,800 out of pocket. The market did the rest. Roughly $247,000 of that ending balance came from growth, not labor. That is the moment most people finally understand wealth. The goal is not to work for money forever. The goal is to buy assets that eventually start working harder than you do. Meanwhile, David didn't ruin his life with coffee. That's not the lesson. The lesson is that he never built the habit of converting small cash flows into ownership. And when people fail to build that habit early, they usually have to make far more painful sacrifices later. Now, let me say something unpopular. The classic latte factor advice is often oversimplified. Coffee is not the reason most Americans can't buy a house. Coffee is not why healthcare is expensive. Coffee is not why rents exploded, tuition soared, or wages failed to keep up in many places. So if you're watching this and thinking, here we go again, another video blaming normal people for systemic problems, I agree with you, if that's the argument. But that's not my argument. My argument is more serious. Small expenses do not create poverty. Uninvested cash flow creates fragility. That is very different, because even when big structural forces are hurting households, the one lever people still control is this: what percentage of my income gets turned into assets? That's the question. Not whether coffee is morally acceptable, not whether you deserve a treat, not whether rich people also buy lattes. Of course they do. The difference is that wealthy people typically buy consumption after they've built ownership systems. Most middle-income households do it in the reverse order. That sequencing difference is enormous, and the market rewards sequencing. There's another twist here. Once you start redirecting money into investing, most people immediately make a second mistake. They think they now need to become stock-picking geniuses. You don't. In fact, the evidence suggests most professionals struggle to beat the index consistently. The latest SPIVA US report indicated that 79% of active US large-cap equity managers underperformed the S&P 500 in 2025. That matters because it means the lesson of this video is not become a day trader, it's not find the next NVIDIA, it's not read 14 hours of macro research every weekend. It's much simpler. Take recurring money, move it automatically, buy broad ownership, let time do the heavy lifting. That's why this coffee experiment became bigger than I expected. It didn't just teach me how much I was spending, it taught me how little complexity I actually needed. No genius, no prediction, no market timing. Just discipline, automation, and patience. And here was the biggest surprise of all. At the end of the year, the most valuable thing I gained was not the account balance. It was the psychological shift. Because every time I skipped the purchase, I was no longer asking, can I afford this? I was asking a better question. Do I want a moment of comfort or a future of options? That question changes everything. And once you start thinking like that, you begin to see the entire economy differently. Every dollar becomes a worker. Every expense becomes a trade-off. Every habit becomes a portfolio decision. That is the reframe most people never get. They think wealth comes from dramatic moves, a huge raise, a perfect stock pick, a lucky real estate deal, some side hustle that suddenly explodes. Sometimes it does. But more often, wealth is built quietly through repeated purchases of productive assets while everyone else is distracted by repeated purchases of convenience. That's the truth. Coffee was never the enemy. Mindless cash flow was. So, if you want to apply this without turning into a monk, here's the framework. First, don't start with guilt. Start with measurement. Find one recurring expense that is emotionally small but financially frequent. Coffee works, delivery works, impulse Amazon purchases work, random convenience spending works. Second, automate the transfer. Not monthly if you can avoid it. Weekly is better. Daily is even better psychologically because it mirrors the habit you're replacing. Third, invest it simply. A low-cost S&P 500 index fund or total market fund is enough for most people. The historic power comes less from brilliance and more from consistency. Fidelity's long-run S&P 500 numbers make that point very clearly. Fourth, don't make it all or nothing. You do not need to quit coffee forever. You just need to stop outsourcing your future to convenience. Maybe you buy coffee once a week instead of 5 times. Maybe you cut the habit in half and invest the rest. Maybe you keep the ritual but bring it in-house. This is not about punishment. It's about reclaiming margin. And in a US economy where prices keep moving, rates keep shifting, and financial pressure stays high, margin is freedom. So, did quitting coffee for 1 year make me rich? No, that's not what happened. What happened is better. It made me dangerous in the best possible way. Because once you understand how small dollars become large capital, once you understand that every routine expense has an opportunity cost, you stop thinking like a consumer who hopes things work out, and you start thinking like an investor who builds outcomes on purpose. If you understand that, you're already ahead of most people, not because you quit coffee, because you finally saw what the coffee was really costing. Thanks for watching. If this helped you clear through the noise, hit subscribe. I'll see you in the next one.